Hi, it's Brendan Fleming, and in this video I want to talk about the housing situation in America. The goal would be to make housing more affordable without creating a lot of risk for the federal government or the banking sector. Okay, first, let me explain about a couple different housing options that people have. First is a conventional 30-year mortgage or 15-year mortgage, and that's the standard one where a person goes to the bank and they obtain a loan based on their income and credit score and down payment. The second one is an FHA loan. This is a special type of loan that's backed by the federal government, guaranteed by the Federal Housing Administration. So it's very little risk to the banks. There's certain requirements for it. The person has to have private mortgage insurance. They have to have a minimum credit score that's very, very, very low. I believe it starts around 500. And then if their credit score is a bit higher, they can put down a smaller down payment. I think at 500, they have to put down 10% down. And on up to about 580, they can put 3% down. So it's a lot of risk for the federal government because typically it's aimed for people with lower income and people who are credit challenged. People typically have lower credit scores. The interest rate on these is typically a little bit higher than the conventional mortgage. The new program that I would propose would be a program that would last for between 3 and 5 years for the application period. The mortgage would have two components. 25% of the loan would be guaranteed by the federal government. This would be up to maximum dollar amount of $100,000. The rest of the loan, the other 75%, or if the home is worth more than $400,000 or the loan's more than $400,000, the rest of it would be through the private banking sector. The portion that's the 25% that's coming, that's guaranteed by the federal government would be very closely tied to the 10-year Treasury, with maybe an interest rate of maybe 25 basis points higher than the 10-year Treasury, but it'd be very closely tied to that, which it should be because the federal government is guaranteeing that part of the loan, and the person borrowing is not as credit challenged as, say, an FHA loan, so it's not as much risk to the government. The portion of the loan that's the other 75% that's through the private banking sector, that would be based on market factors, typical market factors on a loan, such as the amount of the down payment, the credit worthiness of the borrower, the income of the borrower, all the standard factors that go into a traditional loan. What this would do overall is drop the average interest on the loan by about 3/4 to maybe 1 percentage point, depending on the credit worthiness of the borrower. If someone's of a higher credit worthiness, of a lower credit status, basically having a lower credit score, their interest rate would be higher, and so the impact actually would be probably greater than 1 percentage point. Someone that's at a very good credit score, it probably drop it maybe 3/4 of a percentage point, maybe up to 1 percentage point. The requirements for this program would be a minimum credit score of, say, 630 to 650. Obviously, someone with a higher credit score would get a better interest rate in the private sector portion of the loan. There would be a requirement to have mortgage insurance on the loan to cover the whole loan. And they'd have to have at least a down payment or the equity ratio of at least 5 to 10% of the amount of the loan. The risk to the federal government would actually be fairly minimal because a couple of things. One is that we're requiring a higher credit score than, say, an FHA loan. So we're dealing with people who are not as credit challenged, so the risk, that part is not as great as with an FHA loan. The other is that having the mortgage insurance would help guarantee that the government gets paid in the event of default, as well as the banking sector. Whoever's holding the note would get paid. The down payment also ensures that there's going to be equity there if the house has to be sold through foreclosure, that there's not as much risk in the loan. Also, by having a limited duration of the application, say in the next 3 to 5 years, this would not be something going forever. It would just be a short term until the housing market can better stabilize. So with this program, this would help people be able to afford houses. A lot of young people are having difficulty being able to afford houses. And it also, for people already in houses, it help free money up. If they refinance their loans, they'd be able to free capital up, and they could use that capital elsewhere.